All right, today we're pulling back the curtain on a really important piece of the US housing market. It's this hidden financial engine that honestly makes the dream of owning a home possible for millions of people. You might have even used it and not even known its name, so let's get right into it. So, let's start with the big question. That traditional 20% down payment, it can feel like a mountain that's just impossible to climb. So how in the world does this system allow so many people to buy a home with just 3.5% down? Well, it all comes down to a really clever way of managing risk.
You can almost picture it, right? Buying a home with a small down payment is kind of like walking a financial tightrope. It's this really delicate balance. But, and this is the important part, there's a huge safety net stretched out underneath, making that journey across possible for so many more people. Man, that path, well, that's where FHA loans come in. They're loans insured by the Federal Housing Administration, and they're built specifically for folks who might not have a giant pile of cash for a down payment. But that, of course, brings up another really critical question. If the buyer has less skin in the game, what on earth makes a lender feel safe enough to approve a massive loan?
Okay, let's flip the script for a second. Let's look at this whole thing from the bank's point of view. Their biggest fear, their number one risk, is default. What happens if the borrower, for whatever reason, life happens, can't make their mortgage payments anymore? That is the fundamental problem that needs a solution.
Let's just be direct here. When a borrower with a low down payment defaults, the lender is in a tough spot. Foreclosing on the house doesn't guarantee they'll get all their money back. So who steps in? Who covers that massive potential loss? The answer to this is what makes the whole system tick. And that brings us to the hero of our story, the financial safety net itself. It's called the MMIF, and it is the entire reason the FHA program can operate with so much confidence. So what is the MMIF? It stands for the Mutual Mortgage Insurance Fund. Just think of it like a giant dedicated insurance pool. Its one and only job is to pay back lenders if an FHA borrower defaults on their loan. And here's the crucial thing to get. This isn't a taxpayer bailout. It's a totally self-funded insurance system.
And this isn't some newfangled idea either. This fund was created way back in 1934 as part of the National Housing Act. I mean, we're talking during the Great Depression. It was designed to bring stability back to a housing market that was in shambles, and it's been the bedrock of the FHA program ever since. Now, who's in charge of managing all this money? That job falls to the Department of Housing and Urban Development, or HUD. They're the ones who oversee the MMIF and make sure it stays healthy and has enough cash to cover any potential losses.
Okay, a giant insurance fund sounds great, but it begs the question, right? Where does all the money in this safety net actually come from? Who's paying for all this protection?
And the answer might actually surprise you. It's not funded by your tax dollars. The money that fills up the MMIF comes directly from the very people who are getting the FHA loans, the borrowers themselves.
Here's how it works. It's basically a two-part system. First, when you close on the house, you pay what's called an upfront mortgage insurance premium, or MIP. Then, every single month, a little piece of your mortgage payment is the annual MIP. Both of these payments flow directly into the MMIF, constantly topping off that big insurance pool. I mean, it's the classic principle of insurance, right? You pool the premiums from millions of homeowners, the vast majority of whom will never default, to cover the losses from the very, very few who might. It's a system where the whole group protects itself from individual risk. So let's put all these pieces together and talk about why this actually matters. What's the real-world impact of setting things up this way? First off, here's a key difference that trips a lot of people up, especially if you're studying for a real estate exam. FHA loans are insured by the MMIF. This is totally different from VA loans, which are guaranteed by the government. So think of it like this. FHA has its own self-funded insurance piggy bank, while the VA makes a direct promise from the government. And this right here brings us full circle, all the way back to our first question. The MMIF is the reason lenders are okay with offering loans with as little as 3.5% down. It takes that huge risk off their shoulders, and that simple fact opens the door to homeownership for millions of people. And hey, if you ever need a quick way to remember what MMIF is and what it does, here's a great little trick. Just remember, mutual money insures FHA loans. Simple, clear, and it sticks in your head. So really, when you boil it all down, here's the bottom line. The MMIF isn't just some boring government acronym. It is the engine, the powerhouse that makes the entire FHA program run, and in doing so, makes owning a home a reality for so many more Americans.
You know, this safety net has proven to be incredibly strong, weathering all kinds of economic storms for almost a century. But it does leave you with one final thought. What kind of massive economic crisis would it take to actually start tearing holes in that net? And what would happen if it did? Definitely something to think about.